If you're a UK business owner, you've probably been relying on dividends to take money out of your company. But in 2025, that might not be your best move anymore. In this video, I'm going to walk you through smarter ways to extract money from your business whilst you stay tax efficient. I'll cover things like director loan accounts, salary strategies, pensions, investments, and also reinvesting. So first things first, why are dividends becoming less attractive as a salary strategy for directors? Well, the tax-free allowance, first of all, for dividends, it's been slashed. It's currently at an all-time low of 500 per year. Ridiculous. In 2025, you could end up paying far more in taxes than before. So what are the alternatives? Let's explore some smarter ways to withdraw money from your business. To start off with, a huge oversight by many business owners is their director's loan account. If you've personally paid for business expenses like travel, equipment, or subscriptions, you can reimburse yourself tax-free through a director's loan account. It's a bit like an IOU between you and the limited company, if you think of it as another person. And another option for that, if your company has surplus cash in the bank, you can borrow from your business instead of taking dividends, but you'll need to pay it back within 9 months of your company's year end to avoid extra tax, but it can be a really good short-term solution. For example, one of my clients needed urgent car repairs after an accident and was having to wait for an insurance payout. So instead of waiting, they took a short-term loan from their company, they got the car fixed and repaid the loan once the payout arrived. No extra taxes, no stress. But a quick tip on that, make sure your loan is below 10,000 to avoid triggering a benefit in kind tax charge. Another option is running yourself a salary through your company's payroll. Now, a salary is not just about paying yourself, it's about minimising tax while still benefiting from state pension contributions. For the 24-25 tax year, the tax-free personal allowance is $12,570, so you can take a salary up to this amount without paying income tax. But here's something new. From the April 6, 2025, any salary above $5,000 will trigger employers' national insurance, which your company has to pay. If your business is paying the higher 25% corporation tax though, increasing your salary slightly could actually save you money by lowering taxable profits because your salary is a claimable business expense. So it's all about balance really. Speaking of which, if you've got this far in the video, thank you for watching. We appreciate the time you spent with us. We release weekly videos with free advice for small businesses and the self-employed, so feel free to subscribe if you want to learn more. It really helps us to grow our channel as well and keep giving you that information and advice. Speaking of salaries, if your spouse, child or other family member genuinely helps you with your admin tasks, marketing even, customer support, put them on payroll. Paying them a salary means extracting money from your business in a tax efficient way. What you do is you allocate them a tax-free amount of $5,000, provided they don't have any other income. That saves corporation tax as well as income or dividend tax, because if you were going to take it out as income and then give it to them out of your pocket, it will cost you approximately £6,000. Whereas if you put it through payroll, it only actually costs you about $3,800. If they're only on the company as an employee and not a director, you might even be able to allocate them a tax-free salary up to $12,570. And that's because as an employer, you also are eligible for employment allowance, and that saves around $10,000 a year in employer NICs. So it means your salary can increase to $12,570 to utilise all of your personal allowance, and that saves you about $2,500 in corporation tax per employee per year. Essentially, as long as you have an employee that isn't a director on the payroll, you immediately get an allowance on employers' national insurance of $10,500 as of the 25-26 tax year. So even if you're paying them above the employer's national insurance threshold of $5,000, you might not have to pay anything. And you can even add them as shareholders, allowing them to dip into the company profits as well, so they can still benefit from the extremely teeny tiny dividend allowance of £500 that you get now. However, their role must be legitimate, so they have to genuinely be doing something in your business. You can't just pay them for doing nothing. Keep records of the work they do. Make sure the salary is reasonable for their job and their hours, because it's usually part-time. And before you ask, no, you can't put your cat on the payroll for admin work. Watching a fish tank in your home office doesn't count. If you've got a clever way to utilise family, friends or a spouse that makes your business more tax efficient, then let us know in the comments below. That leads us into our next topic, pension contributions. Now, instead of paying yourself extra salary or dividends and being taxed on them, your business can contribute directly to your pension tax-free. Now, these contributions reduce your corporation tax bill and they help you build up some long-term wealth as well. And that's because your pension contributions made through your limited company are seen as claimable expenses. You can contribute up to $60,000 per year or up to 100% of your salary, whichever's lower, completely free of tax. But obviously it wants to be money that you're not going to use, because this is putting it away for a longer term basis. But why talk about taking out money from your business if you don't need to? Why not invest instead of paying yourself? Here are just a few smart investment options. So firstly, buy-to-let properties. Your business can invest in rental properties generating passive income. And any rental income that's earned through the limited is subject to corporation tax, which means you might be paying at a reduced rate compared to if you personally owned the property. For example, if you rent a property personally, any profits exceeding $50,000, and remember, this is on top of what you're already earning personally, you pay a whopping 40% income tax on those. However, with a limited company, it's 19% all the way up to $50,000, 25% from $250,000 profit, and then it's kind of gradated in between. That's pretty much half the rate though. And in addition, rather than then taking the money out of the limited, paying dividend tax, etc., set up another company and make an intercompany loan, saving your tax on taking out any deposit that you need. Then we've got commercial properties. Now you can look to purchase offices, retail spaces, warehouses, and other properties that are usually leased to businesses in order to increase the overall value of the business. If at any point you're looking to sell your business, purchasing something like an office space really impacts the valuation because it's an asset of the business. It will show on your balance sheet. This means you might rinse some more money when it comes to selling. Then we've got stocks and shares. Investing through a corporate investment account can grow your money while keeping it within the company. And there are a number of platforms out there which enable you to do just that. And then lastly, we've got other businesses. You could acquire another business, buy another business, expanding your operations, creating new revenue streams. There are specialist agents who specifically look for businesses for sale in different sectors, and talking to one of these is usually a really good starting point for that. Remember, investments really need to align with your long-term goals as well though. Don't just invest for the sake of it. Don't risk your capital on a whim, and make sure you risk assess any potential investment. Finally, if you want to grow your company, reinvesting the profits is often the best move. Few ways of doing this, so think of upgrading your equipment or software so that you can be more efficient and get more done in less time. Or if you don't want to completely burn out, get the same amount done but to a higher standard. Hire staff to free up your time, because it's likely you are actually your business's most expensive commodity, so get cheaper labour and delegate to them. You can also spend on marketing to scale your business through Google Ads, campaigns, or like us, hire a YouTube channel manager to help us grow our online presence. You can develop new products or services so that you can reach a wider range of customers or clients and broaden your reach on the market. Reinvesting actually means avoiding unnecessary tax whilst you're boosting your company's future profitability. So let's be real, you're a business owner. You're not in this to throw money away on taxes. Forget relying solely on dividends, pick a strategy, implement it, and own your financial future. You got this.